My name is Gaurav Razada. I am a professional at iRedge Capital, which is a high-frequency trading firm. And I'm also a faculty at Quantinsti, where we basically deal with empowering people to work on high-frequency trading and algorithmic trading. Now, today's lecture is basically dealing with order book dynamics. Now, we of recently have heard a lot about market structure and how does it basically work in order to provide us profitable trading strategies is basically the crux of the entire discussion. Now, in that sense, what essentially we are going to do is we are first going to establish why order books and why not something else, and then what in order books to look for. Okay, so it will be an hour-long session in which we will try to detail in brief about order books and then how they can be utilized. So let me begin by basically talking about indicators. So if we have traded before, we must have heard of things like oscillators, moving averages, and so on. RSI, and so on, other things, other indicators. But however, what happens is that all of these indicators are basically computed from price. So essentially, first the price happens, then these indicators get calculated. For example, let's take an example of Bollinger Band. Bollinger Bands are basically nothing but we are calculating a mean and we are calculating a band of 2 standard deviation around that mean. So if the price moves significantly, then the Bollinger Band also widens and the mean also moves. Now, if it moves above 2 standard deviation or moves below 2 standard deviation, we can either hope for a mean reversion or we can hope for a breakout. Now, however, in this, the calculation of mean and standard deviation is happening from the price which has come. So it is kind of a look back kind of indicator in which we are looking at the price and then calculating the Bollinger Band, and on the basis of that we are going to say whether the price is going to go down or going to go up. So all such indicators, they are lagging with respect to price. Okay, so that establishes a business case for technical indicators, or rather indicators at large, which are based on price. Now, is there an indicator which basically leads price? That is the primary question. So, recent literature in the last 10 years which has come up in market structure tells us that there are indicators which basically lead price, but only by a few hundreds of microseconds. And this is basically what we deal in order book dynamics. So if imagine a scenario when non-farm payroll data in US is about to come. Okay, so at that point of time the markets are very jittery. So what has happened is that there is an expectation whether the non-farm payrolls are going to be good or bad in respect to whatever is the opinion poll at that point of time by the economists. So if it is good, then the prices will go up. If it is bad, probably the price will go down of the stocks in general. Now at that point of time, we will see that the order books are very, very wide in terms of the best buy and the best sell in the market are wider than usual, and there is significant activity that is happening at that point of time. A lot of buy orders and sell orders are being received in the on the order book. Now what happens is that based on these movements, we can identify whether there is a buying or selling that is happening in the market. So in order to make profit, the fastest trader in the market would execute his orders, and his orders would lead the price. And that is exactly what order books will do. They will tell you that somebody is selling right now in the market, somebody gets the information first of non-farm payrolls, and that person starts selling. That the data is bad, so starts selling. That is the only way he can make profit. So if that is the only way he can make profit, he starts selling, and as soon as he starts selling, we will also start selling. And that is, but for that, we need to understand how order books work. And we'll start from very basic of order books, but we'll see that there are a couple of other things that we are going to talk about in order books as well. So keep listening. Okay. Now, I'm very generally going to breeze through the order books basics. The basics of order books are that in the order books, people basically place limit orders. Okay, so a limit order is basically an order in which you specify a price with a size, and let's say you want to buy, so you have placed a buy limit order at a given price. And if the market comes to that and somebody basically wants to take that price, then they will hit with a sell order and your buy order will get traded. Okay, so that's a limit order. But if you want to immediately get executed, then you will probably use a market order, okay, which will not be seen in the order book. So limit order books are basically called limit order books because only limit orders stand in that in the market. Okay, now there are a few resolution parameters of the limit order books. Very simply, lot size. So lot size is the smallest quantity that you can trade in an order book. So if you look at stocks, the smallest quantity that you can trade is a share, a single unit of stock. However, in futures could be composed of hundreds of shares or maybe thousands of shares depending on what kind of future it is. And the size is the smallest tick movement that is possible for a given stock. Okay, so for example, in US, for stocks which are less than $10 in price, the tick size is essentially 1 cent. From 10 to 100, it is around 5 cents. From there on to 100 to 500, it is around 50 cents. And from 500 onwards, it is probably $1. In Indian exchanges, it is for stocks, it is 5 paisa, which is equivalent to 5 cents in US terms. So it is constant across all assets, not all assets, but all stocks and indices. For currency, it is 0.0025. So that is the smallest price movement that is possible. Now, the best bid is, so now what happens is the order book is aligned in the term that all the buyers in the descending price are arranged. So 100 followed by 99 followed by 98 in a decreasing sequence, and the sellers are arranged in a ascending sequence. So 101 is the best seller, 102 is the second best seller, and so on. Okay, if the tick size is 1 rupee or $1. So the best seller in the market is known as the best bid, who is the highest buyer at that point of time, and the best seller is the best ask in the market at that point of time, and best buyer is the best bid. And this is very dynamic because trades happen continuously. So it is a very, very dynamic order book. The bid-ask spread is nothing but the difference between the best bid and the best ask at any point of time. Okay, now order books are arranged as per price time priority mostly. There are other types of order book rules as well, which is pro rata and so on. But for all practical purposes, in exchange traded markets and which are non-interest rate, it is essentially price time priority. Okay, what it entails is simple. If there are two people and they basically want to place limit orders, and one of them places a limit order at $99 and another comes in and places a limit order at $99.05, $99.05, then, and if somebody hits a market order, the person who has the limit order 99.05 will get a fill first. This is basically price priority. The person with a higher price on the buy side or a lower price on the sell side will get a priority over the other. Okay, in time priority, what happens is both people place the limit order at the same price. Okay, in that sense, whoever has placed the order at an earlier time has a priority. So he will get a fill first if a market order comes, and the other guy will only get a fill if the previous person has gotten a fill. So this is the concept of time priority. So for the first priority is given to price, and the second priority, tiebreaker priority, is given to time. Okay, this is the concept of price time priority in order books. Okay, now we very simply need to understand what are various order types. So I have told you in brief about limit orders and market orders. Okay, but there are other kinds of orders. So there are, especially in the US and Europe, there are several kind of order types that have been devised for various purposes. So, but what happens is that most of the time, and almost at all times, you will see that people essentially use either market orders or limit orders. We can obviously increase the complexity by using multiple order types, but essentially, let's just talk about market orders and limit orders first. Okay, so there are orders which can remain active for multiple days, which are good till day. There are orders which are good only till they are cancelled or the market has closed. So that is good till cancelled. And there are immediate or cancel orders which are known as IOC orders. If they reach the order book and if that price is available at that point of time in the market, they will get a fill, otherwise they will get cancelled. Okay, so that is an IOC order. Now, there is a stop loss order also, in which case what happens is that that order is triggered. That order is triggered, it has a trigger price. So if, and it is usually used by traders when their strategy reaches a stop loss, what happens is that if a trigger price is reached, say $100 is reached, then immediately an order to sell is triggered and it is sent. So basically it's a conditional order on price. There are conditional orders on time as well, but they are complicated. Okay, so now what we need to do is we need to understand how will order books look, okay, in various scenarios. So for example, I've just got an order book in which the best bid, okay, so if you can see, the order books are essentially aligned in a downward, and this is basically ascending price. Okay, so you will see how we'll read this order book is that the best bid is at 82.75 and the best ask is at 82.90. Okay, the best bid size is there are 600 shares at the best bid of 82.75 and there are 23 shares at 82.90. Okay, now if you can see the second best bid, the second best buyer in the market is at 82.65. The third best is at 82.60. So it need not be the case that all of them are essentially one tick apart. They can be multiple ticks apart. Okay, so there's a 2 tick difference between the best bid and the second best bid, and there is just 1 tick difference between the second best bid and the third best bid. Now, if we consider the bidder spread of this order book is essentially 3 ticks. Okay, so let's say what will happen if a market order of size 500 hits the order book. What will happen at that point of time is that the lower order book will be generated, in which 100 shares will be left at the best bid, 500 shares will get traded at a price of 82.75. Okay, and the order book will look like this. That is how the order books will look like. Okay, now what we need to understand is how does a limit order affect an order book. So if at this point of time, the same order book from the previous slide, if we add an order of size 100 to a price of 82.75, then the order book will essentially become, will have, instead of 600 shares, it will have 700 shares. Okay. Now let's say that if we were to add 100 at a price of, let's say 82.60, then what will happen is that instead of this 212, it will have 312. Okay. So this is how markets are affected by orders. Okay. Now there is another dimension to this market order and limit order conundrum. Now, if you can see the axis, one is the y-axis is the price and the x-axis is the time. Now, a market order is executed immediately at whatever price is available. So from the time your strategy releases the order to the time it goes to the exchange, maybe some 10 milliseconds pass. Okay. Now in those 10 milliseconds, markets could have moved. They could have moved in your favor or against you. Okay. So in that sense, market orders have great amount of certainty in time that it will get executed within 20 milliseconds. Okay. However, the price certainty of a market order is quite low. If the markets move, you will get a fill at a bad price or a good price, or you could get a price that you were expecting to get. Okay. So in that sense, market orders are on the lower right side of the the graph. Now, in this sense, what happens to limit orders? Limit orders are on the top left-hand side. In that sense, what happens is we have placed a limit order. We'll get the price. At best, we'll get at least the price that we have put into the limit order, and so the price is very, very certain. However, the time is uncertain in the sense that markets could have moved and they could move away from your limit order price and you could never get a fill. Okay, the price will move away and for the entire day your limit order will stand there and nothing will happen to it. So that is how it is. Now there are other execution algorithms. So let's say you are a hedge fund and you want to buy 100,000 shares of Apple. Okay, so what you will do is you will not place a single order of 100,000 shares in Apple, and you will also not place a single market order of 100,000 shares in Apple. What you will do is you will break them down into smaller chunks of market orders and limit orders, as and when depending on various conditions, whether they suit you or not, and you will basically execute them according to certain plan. Okay, you could execute them over a couple of days and so on. So it could be a VWAP, which is a volume weighted average price, or a TWAP, which is time weighted average price. You could read them up on the internet. But so other execution algorithms will basically be a combination of limit orders and market orders. Okay. Now we come to the research that we do at Quantinsti and the value addition that we'll get from Quantinsti. So what we do is we study the market data and the order books, and we see empirically that most of the market data in Indian markets arrive close to the best bid and the best ask. Within 5 ticks of the best bid and the best ask, 95% of all orders are placed. Now, this has two implications: that the market depth is low compared to other world markets, and the second thing is that if you want to execute a big order, you can expect a movement against your order. Okay, so people will basically see that there is a big buyer or a big seller, and they will move their quotes accordingly. So you cannot hit a big market order; it could significantly move the market. Now, why is this so? So there are order to trade restrictions in Indian exchanges. So basically the regulators and the exchanges have put up a rule that for a given number of orders that you have placed, there should be X percentage of them should have been trades. Now this has been done across a lot of exchanges in the world, and this is basically because nowadays computers basically place orders, algorithmic trading systems. So people keep unnecessarily replacing a lot of orders. So in order to restrict and put a clamp on those algorithms, this is a simple strategy by regulators and exchanges to basically control. But what it does is it inadvertently results in thinner order books and lower market depth. At least that is what's true in Indian exchanges. However, in the in other exchanges, we see that most of the orders are within 10 to 15 ticks of the order of the current best bid and the best ask. So as a result, they have more volume capacity to execute your orders, bigger orders. Okay, so this is how it looks on a histogram, that almost 57 to 58% of the orders are coming at the best bid, and the second best bid you see around 35% of the orders, and the rest are on the third and the fourth. Okay, now this is something which we have developed at Quantinsti, and this is a tool which basically helps us identify the replacement patterns in order books. Okay, so basically when you place an order, so you have placed an order to buy at 95. Now what happens is that you see that you're not getting filled, so what you will say is, I'm now willing to buy at 97. So what you will do is you can either cancel your original order and set in a new order, or what you can do is you can replace your original order. So, and most of the times what happens is that strategies will basically replace their orders, because replace is a single instruction, whereas cancel and place new are two instructions. So it is far more efficient to replace, and therefore strategies will mostly tend to replace. However, we also study the cancel behavior and the new order placement behavior in order books. Now, in this replacement transition mechanism, we have, so basically I will first show you a transition, and then I will try to talk about the intuition behind this transition. Okay. So the best ask in the market is at 100, the best bid in the market is at 97, and our current order is at 95, which is 5 ticks away from the ask. Okay, we could now this order is moved to a price of 98. So from 95 it is moved to 98, and therefore it is moved by 3 ticks. So we call this a minus 3,5 transition. Now what does this tell us? So our study has told us that most traders move their orders if the best ask in the market, most buy orders will move if the best ask in the market moves. So if the best ask moves from 100 to 99, we will see what number of orders move from their original location and where do they move. Okay, so if somebody was placing has an algorithm which says that always place an order 4 ticks away from ask, and ask moves from 100 to 99, their original order will be replaced from 96 to 95. And this movement we can capture if we are listening to a tick-by-tick order book. Okay, so what happens is that this allows us to capture the average behavior of an order book, and given that average behavior, we can find out if the behavior at this point of time in the last 1 second is abnormal. If this behavior is abnormal, then we can basically take advantage of it. Okay, because any trader will leave footprints in the market. Okay, so let me try to give you a visual on how we will basically use this before we go on to other examples. So say that say the same example of the non-farm payrolls. So the non-farm payrolls data has just come in, probably has not yet been announced on Bloomberg and Reuters, but somebody who is reading on a news feed has already knows that non-farm payrolls data has come, and it is bad, and he wants to sell. Now, if he wants to sell, what he will do is he will hit a market order. Okay, he will hit a market order, and the best bid in the market will get hit, and a trade will happen. Okay, as soon as the best bid in the market gets hit, other people, they will start replacing their order to a lower price. All the buyers in the market, they will start to reduce their orders, or they will try to cancel their orders. Okay. Meanwhile, the sellers in the market will, what they will want to do is, they will want to move their orders which are currently present in the order book to a lower price, so that they are more aggressive sellers. Okay. So at this point of time, the behavior of the seller is that to get a fill at the best price possible. Okay, so all the sellers will be replacing their orders to a lower price, and all the buyers will also be replacing their orders to a lower price. So what you will see is that the transitions would essentially be 2, 5. They will be moving away from the ask and not towards the ask. Okay, so they will essentially be moving in this direction and not this direction. Okay, so what will happen is that you will see that all the asks are moving forward. They will be having this kind of a movement, and these guys will be having, the buyers will be having a lower movement. If we can assess this, then we are basically knowing that the price is going to go down significantly. Okay. Okay. So now that we know what does a minus 3,5 transition looks like, let us see what a minus 3,3 transition looks like. A minus 3,3 transition means that we are 3 ticks away from the ask, and now what we are doing is we are moving our order from current price to plus 3 ticks, which will essentially mean that we are replacing our order from ask minus 3 ticks to ask, which will basically mean that we are getting traded. Okay. A transition of 0, 1 will mean that we are currently at the best bid in the market, because 1 is the minimum. So if the ask is 100, the bid is 99, and we are at 99, and we are replacing ourselves to 99 itself. Okay, which will essentially mean is that either we are increasing the size of our order or decreasing the size of our order, or we are replacing. Some exchanges do allow us to replace at the same price with the same size as well. So you could be replacing needlessly. Okay. Now a 0, 2 will mean that you are replacing yourself from ask minus 2 ticks to ask minus 2 ticks. If the bid ask spread is 2 ticks, then you are replacing yourself from best bid to best bid. If the bid ask spread is 1 tick, then you are replacing yourself from second best bid to second best bid itself. And 1, 1 will mean that you are replacing from ask minus 2 ticks or ask minus 1 tick to ask minus 2 ticks. So you are basically going down in the order book. Now this is what we are interested in. We are interested in the replacement transitions. So now you can visualize how essentially order books can be looked at. So this is one trick that we basically use in our course. So now what will happen is that you will have, over a period of time, maybe for a day, when I analyze this, we get this kind of a matrix. So it basically tells us that how many times did people from ask minus 1 tick they have moved Okay, so if you can see that at this point of time, people are the number of times. So if there are 100 orders, 1% of the orders are basically moving from the best ask when the bid ask spread is 1 tick to trade at the best bid. Okay. Now, if the bid-ask spread is 2 ticks, then 1.4% of the orders are essentially moving from best bid to trade on the best ask. So this axis will define where the order is, and this will define how has the order moved. Has it moved in a positive direction or has it moved in a negative direction? Okay, so this is essentially what tells us. Now we can look at it in terms of a heat map as well, or we can look at it in terms of a density chart, but this is essentially what tells us what the average behavior over the day is. Now, when the markets are moving up or down, we can also identify those replacement behaviors, and we can contrast this replacement matrix with a movement replacement matrix. Okay, and it will tell us whether the market is going to move down or going to move up. Okay. Okay. Now, I just wanted to give you an idea about what is the number of orders that are being placed from colos and non-colos. So on an average, around 65% of the orders are placed from colocation, which are basically placed very close to the exchange, and they give an advantage in terms of timing to the participants. However, if you look at it, around 55% of the orders, or rather close to 60% of the orders which trade are basically placed from non-colo. So there is basically a significant difference between the colo behavior and non-colo behavior in terms of orders and trades. Now I just wanted to give you an idea of how have exchanges developed over a period of time. So if you look at around 6 years back, National Stock Exchange in India was only giving a broadcast data which was being relayed at a frequency of once per second. Then around 5 years back, they moved on to TCP tick by tick data. Then around a couple of years back, they moved to multicast tick by tick, which is even faster. And they have included numerous other tricks like trade execution ranges. So you can basically study all of this and derive far more powerful strategies than just indicators. You have to basically look at how markets are being developed and how order books are created and what kind of information can they give you. If you look at other things, there is significantly faster trading at 200 microseconds. There are self-trade prevention checks and so on. So these are a lot of developments that have happened and which have changed the way trading has happened. And you need to be abreast with these changes. And this is what the program at Quantinsti will allow us to do. We'll be able to provide you the latest data, the latest information about various exchanges, and so on, and it will basically give you an edge. Now, I just wanted to talk about a bit about how high frequency trading essentially happens. So, if you see, around 5 years back, there was hardly any liquidity in stock options in India, and what happened is that the costs were lower, and then as a result what happened is that more people came in and there were more opportunities to trade, and therefore volumes also came up. But this is a vicious cycle. So if you have more volumes, you have lower costs and you have more opportunities, but if you have lower costs, then you have more opportunities and you have more volumes, and so on. So what happens is that it also depends on the costs in the market. So okay, now I wanted to give you an idea of how frequency trading essentially happens. Okay, so there is a concept of statistical arbitrage, but this kind of an arbitrage is basically structural in nature and not statistical. I'll explain this in greater detail, but let's look at it like this: that Sensex future has Reliance stock as a component of it. Okay, so Sensex index has Reliance stock. Reliance stock is highly correlated to Reliance future. Reliance future is highly correlated to Reliance options, which is puts and calls. Puts and calls are highly linked in terms of delta and in terms of vega and in terms of direction as well as volatility onto the Sensex call and puts. Okay, Sensex options, and essentially the entire chain. So if any of these chain breaks, there is a trading opportunity. Okay, so how do we visualize this? Sensex future has, say, 12% of Reliance stock in its weight. This stock is directly correlated to futures. Futures are directly correlated to Reliance puts and calls, and Sensex puts and calls are directly linked to Reliance put and calls. And they, by the principle of put call parity, are linked to Sensex futures. So as a result, Reliance stock is linked to Sensex put and call, or Reliance future is linked to Sensex future, or Reliance future is linked to Sensex calls and puts. So these are the kind of relationships that we are looking for when we are doing statistical arbitrage. Okay, now this is basically the key slide, the structural versus statistical correlation. Now a statistical correlation is you throw in data and the numbers come out. So say the correlation between Axis Bank and ICICI Bank is, say, 0.7, which means that 70% of the time they move together. But what happens is that Axis Bank basically has a bad quarter, ICICI has a good quarter, so their correlations will suddenly go down. ICICI will move up, Axis will go down, and therefore, but on an average over a long period of time, their correlation was 0.7. But at that point of time, their correlation significantly drops down, and you basically find that a trading opportunity. But what could happen is that ICICI could be doing far better, and therefore, and Axis is not. So over a long term, this correlation could go down. So these are present, but what happens is that their nature is highly dependent on the fundamentals of those stocks. Okay, on the performance of the individual stocks. However, in a structural correlation, what happens is that the index is linked to its index components, and it's a mathematical equation, so it will always be linked. Any opportunity in that index, any break in that index formula, and you can basically take advantage of it. So similarly, you could say that volatility arbitrage. So people basically look for small volatility discrepancies, and they basically will trade that. So you could basically trade the call smile versus the put smile, and so on. Okay, so this is basically what high frequency trading does. They basically take advantage of these small price discrepancies, and that is where their bread and butter is. Okay, now what is happening is that there are new instruments that are coming into the market. There are ETFs which are coming up in a significant manner. There are interest rate futures which involve pricing methodology. So you need to be able to price index given the price of bonds. You have VIX futures, which are essentially volatility indices. These are highly traded in the US. They have started in India, and they are doing significant volume. So you need to be able to price VIX futures. You could develop strategy ETFs. You could trade bonds. You could trade instruments which are present in the developed markets. Now I just wanted to come to the concept of latency. Okay, so there is this wonderful article which was written by Stuart Cheshire in 1996, when the speed bandwidths were speeds of internet or speeds of computers of the networks were in kbps. So he at that point of time wrote a very small article which is still available on the internet. A network link with low bandwidth can be made better with money, but a network link with bad latency cannot be held. Okay, so what he essentially meant is that if from a distance point A to point B, you are taking 3 milliseconds, you can basically buy more bandwidth, and in 3 milliseconds you will be able to transfer more data. However, if the same link is taking 13 milliseconds, even if you put more money at it, buy more bandwidth, it will continue to remain at 13 milliseconds. Okay, so the next example will give you an idea. So a Boeing 747 flies at the same speed as 747, but 737 basically carries only 150 passengers, while 747 carries 500 passengers. So will we say that 747 is faster? No, it is 3 times bigger than 737. Now a Concorde, which has stopped flying in the last 5 years, but it could travel far faster, but it could carry a smaller number of passengers, but it was faster and its bandwidth was lower. Okay, so that is the concept of latency and bandwidth. Now at Quantinsti, what we will do is we will basically teach you about the concept of event. Okay, so in normal programming, what happens is that you build a program, you build an executable, and you basically execute that executable. Okay, and it basically does a compilation. It does a run over the data or whatever the program does, and it allows you to basically get the calculation out. However, in algorithmic trading, what happens is that we basically develop a code which basically runs on various events. So if the market data changes, then a certain piece of code is run. If we have sent an order to the exchange and we get a fill, then a certain piece of code is run. So all codes are basically run on events. Okay, so algorithmic trading is totally about on-event processing. Okay, and your code must be faster and robust. Okay, robust because you could not afford to lose money, and it has to be faster in the sense that you should be able to react very fast to the changes in the market data and so on. Okay, now in terms of speed, we are going to teach you about hardware innovations, what kind of hardware to use. Can you use an i7 processor to do high frequency trading? What is the difference between an i7 and a Xeon, which people basically have assimilated over years by doing research. We'll be basically providing you that kind of information. Now, why should we aim to be the fastest? To remain competitive. Currently, the latencies are in the orders of microseconds. Okay, at various levels, there are various speeds that are required. So we will, depending on the strategies that we will discuss in the course, we will be teaching you all of this information as well. Now, we'll also teach you the concept of latency, how much latency is good, how much latency is bad, what are the thumb rules to latency management, and so on. Now, we basically need to have the concept of network. Okay, so the concept of network. Now there's a firm called Corvil which has done quite recent research, which is involved in very decent research in algorithmic trading. And what it provides us is with a very, very granular level of network data. So on an average, what we will see is that at per second level, we will see that we are only using 200 Mbps of the network. However, what is happening is that this data, it comes in discrete packets. So if the market suddenly moves in 10 milliseconds, you will get certain amount of data. And when you calculate it per second, you will see that that data is coming out to be 2 gigabits, okay, or 2000 Mbps. So at this point of time in the market, you will see that your bandwidth is getting throttled. So you will basically want to keep a significantly higher amount of number in your bandwidth so that you are able to take care of the microbursts. These are known as microbursts. Okay. Now there are exchanges which have provided very decent information. So this is basically from BATS, which is an exchange in US, and it tells you that there are 4 kinds of feeds: multicast pitch, TCP fast pitch, and top. Okay, and they also tell you what is the kind of bandwidth requirement you have for each of them. Okay, so if you are listening to this kind of feed, then you need a data cable that is that thick, so that it can basically take the load which is coming in from the exchange. We'll also talk about various things, but these are mostly from system development's perspective. So if you are a hardware developer, you would be very, very interested in this. If you are a software developer, you are interested in the left part. If you are a hardware developer, you are interested in the right part. Now, from 100 Mbps Ethernet module, you could basically move on to a FPGA or an InfiniBand kind of a network, which is 40 gigs. And it totally depends on the kind of requirement. If you are into high frequency trading, you would be moving towards the right hand side. If you are into algorithmic trading at an average execution time, you would be towards the left hand side. Okay, so this is basically the entire thing. Now we will teach you about various things. We'll talk about servers, we'll talk about operating systems, but we will teach you what is essentially required and what is basically in your control. So you will need to do, so what all you can do to make your systems faster and basically get the best output from your strategy. So those kind of things we'll talk about in our program. Okay, and then what we'll teach you is the iteration. Most complicated thing in the entire workflow of strategy development is the iteration. So so what will happen is you will write a piece of code, you will run it in a test market, and you will see that it works fine. If it does not work fine, then you will go back and you will recheck what does not work. So nothing works right the first time. You will have to take several iterative attempts to get it right, and that is expected. But what will happen is that now your strategy is working fine, but your network needs to be tweaked. So you will basically do several things at the network level and see if the network is fine. And then what you will do is you will see whether this is working fine. If this is not, then you will break down your entire strategy into components. So from the market data adapter to the strategy, to the order routing, to the network, to the hardware that you have put your stuff on, and everything else, you will need to basically do an iterative. And we will basically give you insights into this from our experience over the years. So this is essentially what I wanted to basically give you an insight. The most important thing in the entire algorithmic trading domain and high frequency trading is that you will be able to get leading indicators to price. You will have hardware that will allow you to do it. You will have the entire know-how and the knowledge set that will provide you a key insight into how to enter algorithmic trading or high frequency trading. Now, basically, you can if you have questions, we can probably do a small Q&A. Please send me.
Hi, am I audible? It's Mahinda this side.
Hello.
Am I audible? Hi, Gaurav. Am I audible? Not audible.
Okay, so there's one question that I can see by Samarji Satpathy. Which programming language knowledge is essentially required? So basically, these days there was essentially a distinction earlier between C++ and Java, that Java is slower because it is compiled at runtime and so on and on. But nowadays, there is no such distinction. However, what happens is that most people tend to use either C++ or Java. So for data analysis, you would be using R or Python or MATLAB, which is a significant portion of algorithmic trading. So you will be doing the entire analysis on one of these platforms. And then the programming can happen on any platform that you prefer or that you are comfortable with. Okay, so it totally depends on the developer, how he wants to develop the platform. It totally depends on the programming language knowledge that the developer has. Okay. Then there is another question about how fast can one understand to do programming for layman? Manish Choksi. So basically, if you look at the difference between an algorithmic trading program, an algorithmic trading setup, and a normal trading setup, you will see that there are traders who have developed their own trading systems, and they are basically running it in normal. However, if you look at an algorithmic trading setup, you will see that there are developers, which are programmers, and then there are quants who are basically sifting through data and finding out patterns and so on. And then there are traders who are basically giving them insights about market and what they want to trade. Okay. So if you are a developer, you basically need to be really good at programming. If you are a trader, you need to understand, you need to basically be able to put the entire flowchart of the trading strategy. How do you think, what will change so that you will take a position, or what will happen that you will cut your position? You should be entirely able to put the entire thought process onto a flowchart in a step-by-step manner. So that is your that is a trader's input into the algorithmic trading domain. The quant needs to be able to take that flowchart, convert it into numbers and statistical distributions and so on, and give that to the developer. The developer needs to be able to code that, what the quant passes him, and so on. But all three need to understand each other. So in that term, Manish, it is not really difficult. If you are looking from a trader's perspective, you really don't need to understand a lot of programming. You can basically work with basic essentials of programming and not really. Okay. Then there is a question by Ronald Feldman. You mentioned a fund called Corwell. No, Corwell is not a fund. It's a firm which basically does network analysis, and its name is Corwell. If you join EPAT program, which programming language would you require to know during the course delivery? Also, whether R, MATLAB, or Python will be used during the course delivery. The course delivery will, okay, so we will be using C++ in our program for developing the strategies, because we provide you with a platform on which you can run your strategy and backtest it with real-time data onto a simulator. Okay, so we'll be providing you the state of art. Now that uses C++, and for the data analysis, we'll be using R, which has quite a few packages already made available, and it is free and it's open source, and you can do so much more. And MATLAB requires licenses for individuals. So a lot of people are now preferring to switch over to R, which has far many functionalities, and it's statistically friendly to people as well. You get so much more material. Yes. So Milind, Algo trading possible for retail small traders? Yes. Recently, couple of years back, it has been allowed, and there are several brokers you can check online as well for which broker currently provides in India. Probably you could call up Akhil at our help desk, and he'll probably be able to help you out and connect you with the brokers. Ronald has a question: do you provide free sample code snippet for algorithms like MATLAB? Yes, we do. We will teach you a number of strategies. We'll start from a simple buy and hold, where you will buy a single stock, and so probably you get bought at $100. Now you want to cut your position either when the price reaches 102 or if it reaches 98. So that is basically going to be your first strategy. Okay. Now that will be your first strategy. Then we will go on to pairs. We'll do multiple kinds of implementations of pairs based on errors and so on. And then we'll move on to options. We'll do a significant amount of options, because options are the ones which basically can be used with leverage. So options will be used, and then we'll go on to various arbitrage strategies like basket arbitrage, index arbitrage, volatility arbitrage as well. And then we'll move on to high frequency trading algorithms with Bayesian analysis of market data and so on. So you will have your hands full with strategies, don't worry. Do we need alpha membership? Not really. You don't need alpha membership. You could probably talk to your broker and he can provide you direct market access. So that's not a problem. Do you develop algorithm programs based on strategy developed by me? Not really. Your strategy is your own secret sauce, so you could keep it. I use R and Python for my advanced analytics. How much is this relevant to me? Significantly. Most of the quants in the markets in high frequency trading domain, algorithmic trading domain, use Python and R. You would be using IPython, I guess. Then there was AmiBroker API is okay with algos. Not really. If you want to develop a high frequency trading system, AmiBroker would not do. But if you are building a technical trend system or something like that, then probably AmiBroker is decently good enough. Okay. Any other questions? Kalpesh has a question. Do we have to approve strategies prior to put in online? What data we may have to share? You only need to provide very basic information to the broker who will provide it to the exchange regarding the risk management processes that you implemented in the strategy, so that there is no disaster surprise for anybody in the markets. Oh, so you could, Kalpesh, you could have a look at the SEBI circular, which is the stock exchange circular, the regulator in Indian markets, and they basically tell you what information you have to share. So they will give you the exact wording of what you essentially need. Do we Bayesian belief networks in course? Not really. Not really. We do a bit of Bayesian analysis, but not the exact thing that you want. We will, and so the program will involve one project. And that project will be development of a full strategy from ideation to execution. Okay, and this can be anything. So we will have, and you will basically be interacting with one faculty member who will be specializing in that domain. So if you are probably working on market structure studies, then you will be interacting with me. If you are working with, if you are working on say neural nets or Bayesian belief networks or deep learning and so on, then there are other people who will help you out. So that will be taken care of. What is the duration of your training course? Cost exams at the end of certification? Yes. So the duration of the course is around 4 months, around 100 contact hours, classes 3 hours each on Saturdays and Sundays. The cost is around 1.5 lakh Indian rupees or 2,500 USD. If you register today, then you'll get a 10% discount. So you could probably talk to the Quantinsti support. There is a project, and yes, after every class there are kind of assignments which you have to finish, and these assignments are the ones which are designed to make you think. Okay. Oh, you can access this recording. It will be basically emailed to you, so don't worry. Samarji Satpati has a question. Algorithmic trading does not guarantee you. No, nothing. Nothing will guarantee you a profit. But what happens is that algorithmic trading, you basically use probability. So if the probabilities are in the favor of 80:20, then you have a probability of 80% of probability to make profit. Then they are heavily stacked in favor of you. So if you see a lot of high frequency trading firms, they have never made a loss in that sense. Yes, Hasmukh, you have a question for non-programming guys. It is possible. Yes, it is highly possible. We also have primers on programming, on markets, and on quantitative techniques, especially for people. So if a software developer comes in into the program, we will basically be updating him about markets, and we'll also be updating him about statistics and mathematics that we are going to use in the program. So we have primers, and 3 primers are there. One for programming, which is into strategy, this thing, and we'll have a session. We'll have a couple of sessions on markets where we teach you about the how markets are, how they behave, and so on and on. We'll give you insights, and then we'll basically have statistical sessions as well. So it basically helps you to bring you up to a certain level before we begin the session in earnest. Weekend class, yes, it is a weekend class only, and because most of the participants, they are not students, they are practitioners and they are working professionals, so we have kept them only on the weekends. It is online as well as classroom, so just like you are listening to the webinar, you will have interactive webinars, interactive sessions, where you can also come into our facility at Boomerang in Mumbai, and you can also see the entire thing online. Yes, quant is highly useful in cash future and cash arbitrage. Yeah, please tell me. Any other questions? Thank you, Manish. Thank you, Mahendra. Oh, so we basically, Milind, we keep very small batches because we have to focus significantly on the course. So we'll keep them max to max 10 to 12 people in a batch. So we have already enhanced our facility where we have all the so we can basically handle close to 25 students right now, but we will not increase that. We'll basically want to significantly focus on our students, on participants, to make them make this exercise very profitable and enjoyable. Any other questions? Oh, said we'll basically provide you algorithmic trading data, and you can basically have a look at the data, and you will get access to order sizes and so on. There are several places on the internet where you will be able to access thematic data. So it will also make that knowledge available to you. Ronald had a question. Do you see currently many pair trading? Yeah. Around from 2009, we had 0% of algorithmic trading, and now we are close to 40% of volumes are algorithmic trading. So it is pretty decently picking up here. The global average is around 75%. So over the next 5 years, we will see a move towards algorithmic trading, reaching 75% of the total volumes. And since it's a growing market, therefore there is significant profitable opportunities as well, unlike other places where it has already peaked in a sense. Any other questions? How risky is algorithmic trading? So any trading is risky, but the thing is that since it's driven by a system and not by a human is prone to mistakes. A system is prone to do the things that has been programmed to do in a very, very good manner. So the risk is far, far lower in terms of market risk. You will be able to cut your positions if they are negative, if they are against you, whereas a human will start to think whether I'm sitting on a good position or a bad position and so on. So there is no dilemma in that sense. Whatever it has been programmed, yes, we basically trade. I myself in the market. Do you see any merit in CQF certificate after doing 4-month course on quant trading? Yes, so CQF and EPAT, which is a program which is offered by us, are two separate things. CQF is mostly towards structured finance, where you are trying to price option structures or derivatives which are significantly complicated. There, the knowledge of math and of Ito's lemma and all of that stuff, which is basically quite a decent amount of research is required in that. And this the CQF program basically deals in that. It is mostly done at banks and asset funds. However, the EPAT program is a direct thing in the sense that you are basically being exposed to exchange traded things which can be traded directly on the exchange. You don't need to be at a bank or something to basically start using your knowledge. And what it essentially does is it allows you to start trading. Now, CQF is more of a specialized program in structuring, whereas EPAT is more of a specialized program in order to trade. We also teach quite a bit of statistics and everything, but the statistics is more towards markets in terms of trading markets. What is the minimum fund required to start algorithmic trading? Sasindran Panakal. Oh, minimum fund could range from anywhere from 5 lakhs to probably, I don't know, 200 crores. It could depend, you know. You could have a single strategy, you could have multiple strategies. The minimum fund is probably to get you a broker. So you need to basically talk to a broker. What is the minimum fund that he wants you to basically set up? Do we have fixed protocol also part of the course guidance? Yes. So we will basically teaching you fix. So basically, fix and other variants of it are the language that basically exchanges and the trading servers talk in. So if you check on internet, fixed protocol is basically a standard benchmark according to which algorithmic trading happens. Yes, we'll be talking about it in decent detail. Any other questions? Symphony is a HFT service provider. Yes, it is. Yes, if you call up Sasindran, if you call up the service desk, help desk at Quantinsti, they will be able to help you with some good brokers depending on your geography in India. Level of technical analysis and Excel macros required for EPAT course. We will be basically talking a lot about technique. So basically, if you look at it, technical analysis is a small subset of quantitative finance. Okay, so if you look at moving averages, they are nothing but calculation of a price series in terms of, so you are basically calculating, you are summing up 100 numbers and dividing them by 100. So you will get an average number for 100 prices. Okay, so this can very easily be done in algorithmic trading. So the way I look at it, technical analysis is a very small subset of algorithmic trading. Now, Excel macros, they will talk to you, because what happens is a lot of people are very hands-on. So all the ideas that you generate can easily be tested on Excel, and then you could, then with a lot of data, you could push it onto R. And once you have tested it on R, then you can probably put it onto your trading system. That is how the entire chain is. Yes, so we have placement assistance in India and outside. We basically have a dedicated desk which basically talks to high frequency trading and algorithmic trading funds. And these people have significant requirements for quants, developers, and we basically link our participants to these firms for interviews. And depending on the requirements, these people pick up a lot of our participants as well, because they are significantly trained into the exact thing that these people are. So our participants basically hit the ground running, in a sense. How quant is helpful in cash arbitrage? You would probably have to attend a session on cash arbitrage which we take. Vijay, that would probably give you a very good idea about what kind of quant we are talking about. But you could do loads and loads of things with cash only. You could probably do, or you could probably decide to do one leg, second leg first, second leg. You could decide to quote in both legs. You could decide to do a partial square off. So loads of things that I'm talking about will make sense if you attend that session. What is the average salary? Average salary from a very startup point with zero experience and everything else could be around 10 lakhs. Very good, decent professional could probably easily be around 1 crore. Because these are people who are very few in market, so they command a very decent premium. We'll help you set up HFT company in the terms that you could recruit our participants, Varuna. Yeah, so it's not that much of a problem. We'll teach you each and everything about what do exchanges require, what are the qualifications at various exchanges, how can you set up your own HFT firm, and so on. Yes, we'll go into decent detail about it. We'll especially talk about the regulations, which are a very important part of trading, since it's regulated by a regulator, SEBI, and their exchanges, who are also regulating a lot about firms that are involved in trading. So yes, we'll be talking in great detail about regulations, which are a significant portion of this business. Any other questions? You don't require extensive knowledge, because we'll be providing you extensive knowledge of currency derivatives. Don't worry. All we want is for you to be able to put in hard work and be interested in the program. The rest is, leave the rest to us. We have already placed around 24 batches. This is going to be our 25th batch. And we'll be able to, I hope, satisfy your requirements as well. Yes, Arihant, you have a very good question. So financial risk management, would this be a help in program? So if you see, financial risk management at HFT level is it's significantly different from financial risk management at other levels. In this, what happens is that you are talking about financial risk management at microsecond level. So you would basically be able to relate your experience in financial risk management to high frequency trading domain and algorithmic trading domain risk management. And yes, so this is a key requirement in the markets these days, that there should be chief risk officers and all who can basically provide inputs and insights into how to manage risks at high frequency trading or algorithmic trading domain. And these are highly in demand these days. But for that, you basically need to understand the exact strategy and how it is working. How is financial risk management used in HFT? Will bookmaking positions be naked or hedged? So that is precisely the point. If you are making positions, then how long are you hedged and how long you are naked? And whether the risk management that you are doing, the correlation of that is probably, can it break that correlation, or how probable is the correlation to hold? All of those things are really required. And for that, what you need to do is you need to basically need to do a significantly decent analysis into what are the timelines and so on of high frequency trading strategy. Any other questions? Yes, Milan, you have asked a very decent question. So we will basically be teaching you how fast are your orders getting executed on the exchange, are other people getting their orders executed first, how to basically reach that number where you will be the fastest. So all of this will be made available to you in the program. Yes, Arihant, 4 months are decently good enough. You could. So what we have done is we have basically compressed the program into the exact knowledge that is required for algorithmic trading, from the ideation of the strategy to executional strategy, the entire pipeline. We basically talk about it, how to basically start with the idea, develop it on data, run it, backtest it, then implement it on a trading platform. Once you implement it on a trading platform, how to optimize it, iterate and optimize again and again, and then basically improve your profitability. Hi, Vishwanathan. So basically, I was talking about this replacement matrix in the discussion, and in that, basically, it is one of the ways in which we can identify whether a market is going down or market is going up. So that basically gives us such indicators, give us insights into how market is going to behave. Any other questions? How do you make it prior hand? Oh, based on the order book movements, we can understand whether the market is going to go down or whether the market is going to go up. So that is how it is. Any other questions? Okay, thank you for attending the webinar. I hope it gave you an idea about how Quantinsti program will help you be profitable and learn more about markets. Please get in touch with us if you're interested, and we could probably help you out in developing better strategies. Thank you.